On Wednesday, the stock market started off quite okay, but then in the last couple of hours, when Jerome Powell spoke, the stock market, I think we can call it crashed, maybe dipped. I mean, certainly a dip if you zoom out a little bit, but if you zoom in just on the day, we can say that it crashed, right? But if we zoom out a little bit, if we go to the last 3 months, well, in the last 3 months, we're still up. We're still up. Nasdaq is up 9.14%. S&P is up 4.22%. The Dow Jones is still underperforming by quite a lot, just up 1.73%. If you look at the last 6 months, we're up on all of them quite nicely. Year to date, you know that we're up, well, quite significantly. So yes, it's true that if you zoom in and you only focus on what happened that Wednesday, maybe even on Thursday, who knows, then yes, it does look quite ugly. As you will see in just a second, plenty of stocks have come down quite a lot, right? 5%, 10%, maybe even more, just like that. I've seen plenty of people celebrate their 100% gains year to date and then 3 hours later cry as if this is the end of the world. No, I don't think it is, and I also don't think that this is a Black Monday, August 5th event, as we've seen just a couple of months ago. No, right now we're coming in after, 3 months of stocks going up like there's no tomorrow. So okay, maybe the market is taking a little breather here. Plus, what was mentioned during that speech, was it alarming? Is it bad news? I don't think so. I think there's more good news than bad news, especially if you zoom out a little bit. So let's discuss all of that in this video. I'll talk a bit about what I'm personally doing as well. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. I want to start with a quick overview of plenty of stocks that I'm following, put on a watch list, and what has happened basically yesterday. So on the left here, you can see short-term bets, basically meme stocks, hype stocks, and stuff like that. All of them have come down quite a lot during the day. Only one, which is cooler here, is up 44.4%. And then after hours, well, pre-market, it's up another 27.4%. On the right, more stable stuff. Basically a list of semiconductor stocks. All of them have come down quite a lot during the day, with Micron down another 15.6% after hours because, well, guidance was quite weak. A big miss on that. I did a video. If you missed that, it's going to be in the top right corner. But all the rest here quite red. Nvidia down only 1.14%, with Broadcom down the most here, close to 7%, but Broadcom has gone up quite a lot since they reported earnings a week ago. Funny enough, we also had the Chinese stocks come down across the board. And then all the rest, all the other stocks that we follow, from Uber to New Holdings, Robinhood, Amazon, Palantir, Adyen, all of those things, all of them were red. Only one company was green, believe it or not, that was Uber. Quite funny, quite interesting. Now, with regards to New Holdings, this is also company specific, maybe geographically speaking specific. New Holdings and Mercado Libre, we're going to talk about that probably today or tomorrow, because I know that a lot of you are interested in those companies and maybe are even invested in them. So we're going to talk about that. But all in all, yes, it's true that across the board, most of the stocks, if not all of them, have come down quite a lot, especially in the last couple of hours of that trading day. Now, I wrote here, buy the dip. What dip? I wrote this because despite seeing stocks down 11%, 8%, 5%, 6%, no matter what dip exactly? What dip? We're just back to prices not seen since when? Monday? Friday? Is that considered a dip? Maybe by some, yes. But to me, a dip, I want to see it a little bit deeper. That's actually a good one. Anyways, by the dip, I think this is just premature right now. I think there's more to be seen in the next coming weeks. I don't think we're going to see huge crashes, as you will see in just a second when we're going to discuss the, let's say, broader economy. But I've seen a lot of people, oh, buy the dip, congrats to those that bought the dip. You bought what? You bought prices not seen since 3 days ago. Did you buy 3 days ago? What's the point now, right? This constant chasing of dips and hype and whatnot just doesn't make any sense. Plus, like we've seen at the start, if you zoom out, most of these stocks, if not all of them, are still up, 20, 30, 50, maybe even 100% in the last 2-3 months or so. So literally, what dip? No dip. On another note here, the 10-year US Treasury yield sits at 4.53% right now. 3 months ago, that was 3.74%. So yeah, maybe now still a lot of folks might be saying, okay, look, risk-free rate, this makes more sense than invest in individual stocks, especially at current all-time highs, let's say. So we might switch from individual stocks to this thing right here, because 4.53%, that's quite high. This can of course also potentially negatively impact some stocks, right? Higher borrowing costs for company, potentially lowering profits and stock valuation, higher discount rates on future earnings, reducing stock price multiples, especially now that, a lot of stocks have, multiples that are pretty close to the moon. And then for the general economy, this is basically increasing cost of borrowing for consumers and businesses, potentially slowing spending and investment, which is maybe what the Fed wants. This also creates higher interest payments on national debt, affecting government fiscal policy. Maybe the Doge program next year can fix that a little bit. And this could signal expectations of economic growth rather than inflation based on, real yield increases. So let's talk about what was mentioned yesterday, right? So they said the following: the US economy is described as performing extremely well, with GDP growth forecast for this year upgraded to 2.5% and in next year slightly revised to 2.1%. Consumer spending remains resilient, contributing to what has been called remarkable growth. The labor market is cooling at an orderly pace, with current and future unemployment rates lower than previously expected. This indicates a balanced approach to managing economic growth and inflation without immediate concern over employment. The increase in inflation expectation has prompted the Fed to adjust its federal fund rate forecast upwards, setting expectations at 3.9% for the next year and 3.4% for the following year, both 50 basis points higher than previously anticipated. That's probably also one of the reasons why the stock market reacted, let's say, negatively. Then the last thing here, the long-term natural rate was also revised from 2.9% to 3%, suggesting a higher baseline for what is considered a non-inflationary, non-restrictive rate. These changes are driving the negative market reaction due to expectations of sustained higher interest rates. And so while right now the immediate reaction of certain people, maybe some headlines as well, is that, oh, stock market crash imminent, the end is near, blah, blah, blah. But in reality, everything that's happening right now is exactly what you want to see, especially if you're a long-term shareholder or just a shareholder of good companies right now. Because what we're seeing is that, the consumer is quite resilient, the economy is growing. Yes, okay, maybe rate cuts are not going to be 4 cuts in 2025, now only down to 2. Big deal, right? Is that why you invest? Because you were expecting 4 rate cuts and now you only got 2? Would you rather have, I'll just say it like that, option 1, 4 rate cuts next year, consumer spending not that great, economic growth not that great? Or option 2, 2 rate cuts, economic growth quite good, consumer spending quite good as well? I think it's pretty clear to me which option you will choose, right? The option where the consumer confidence, consumer spending is good, economic growth is good, and you still get 2 rate cuts, which is exactly what was expected right now. Of course, we don't know what will happen in 2025. A lot of things can happen, but that's currently what's going on right now. And in my opinion, yeah, maybe Wednesday was an overreaction, but in reality, I think it was time for a small correction, let's call it, right? After weeks and weeks or maybe even months of everything going up. And then you get to a point where things just don't make sense anymore, right? When we have companies that barely generate any revenue that are worth billions of dollars, you know that it's time for a little correction. I'm not saying we're going to enter 2022 bear market type of things. No, not even close, but it's always healthy to have a little pullback and maybe let the businesses do the talking instead of the stock and instead of the multiples continuing to go up and up and up. So overall, what am I doing right now? Purely looking. Yes, there are some companies that are looking attractive, not just because of Wednesday. Some companies have been looking attractive already for a couple of weeks. Mercado Libre, New Holdings, Uber. Uber, I'm a shareholder. Mercado Libre, I'm a shareholder of. And New Holdings is getting quite interesting, but New Holdings and Meli, there are some, well, company-specific, let's say, issues or maybe concerns, which we're going to tackle in another video. So no, I did not buy anything on Wednesday. Maybe I'll buy something on Thursday or Friday, or I'll just wait for next week and see how the market reacts. All in all, you have to be patient, not overreact, and look at the reality of things. We're doing quite well as an economy, especially in the United States. Some stocks are doing much better than what the business actually reflects. So it makes sense to see a correction in certain stocks. That's it. Anyways, do share your thoughts down in the comment section below, like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.